Right now, inflation is running at 4 to 5% annually. Your savings account is earning just 1.5%. That means you are losing money every single day. A $10,000 savings account is losing approximately $250 to $350 of real value every single year. That is approximately 68 cents of real value lost every single day. Over 10 years, that same $10,000 will have lost approximately $3,500 of real purchasing power. Over 30 years, it will have lost over 70% of its real value. But here's the number that will completely change the way you think about money forever. That same $10,000 invested in the S&P 500 in 1990 would be worth approximately $200,000 today. The difference between those two outcomes is not luck. It is not connections. It is simply one decision. And today we are going to prove mathematically exactly what that decision costs you every single day you delay it. Inflation is the silent killer of ordinary people's savings. The US dollar has lost approximately 96% of its purchasing power since 1913. A product that cost $1 in 1913 costs approximately $30 today. A product that cost $100 in 1990 costs approximately $230 today. In 2022, inflation hit 8.8% across advanced economies, the highest level in over 40 years. The average American savings account currently earns approximately 0.5 to 1.5% interest annually. With inflation running at 4 to 5% annually, the average savings account is losing approximately 2.5 to 4.5% of its real value every single year. On a $10,000 savings account, that is a real loss of between $250 and $450 every single year. On a $50,000 savings account, that is a real loss of between $1,250 and $2,250 every single year. On a $100,000 savings account, that is a real loss of between $2,500 and $4,500 every single year. This is happening silently and invisibly to millions of ordinary people every single day without them ever realizing it. Albert Einstein reportedly called compound interest the eighth wonder of the world. He said those who understand it earn it, and those who do not pay it. Here's the mathematical proof of exactly why he said that. If you invest $10,000 today at an average annual return of 10%, which is the historical average of the S&P 500 since 1928, that's after 10 years that $10,000 becomes approximately $25,937. After 20 years, that $10,000 becomes approximately $67,275. After 30 years, that $10,000 becomes approximately $174,494. After 40 years, that $10,000 becomes approximately $452,592. Now here's what happens to the same $10,000 kept in a savings account, earning just 1.5% annually. After 10 years, it becomes approximately $11,605. After 20 years, it becomes approximately $13,469. After 30 years, it becomes approximately $15,631. After 40 years, it becomes approximately $18,140. The difference between investing and not investing on a single $10,000 amount over 40 years is approximately $434,452. That is the mathematical cost of one single decision. As now here is the most devastating data in this entire video. It is called the cost of waiting, and the numbers are almost impossible to believe until you see them. Person A starts investing $200 per month at age 25. At an average annual return of 10% by age 65, their portfolio is worth approximately $1,274,000. Person B waits just 10 years and starts investing $200 per month at age 35. At the exact same average annual return by age 65, their portfolio is worth approximately $452,000. The difference between starting at 25 versus starting at 35 is approximately $822,000 from the exact same monthly investment of just $200. Person C waits until age 45 to start investing $200 per month. By age 65, their portfolio is worth approximately $153,000. The difference between starting at 25 versus starting at 45 is approximately $1,121,000. Over $1 million lost simply by waiting 20 years to start investing. Every single year of delay costs approximately $56,000 in lost final portfolio value. Every single month of delay costs approximately $4,667 in lost final portfolio value. Every single day of delay costs approximately $153 in lost final portfolio value. $153 every single day simply for waiting. This is the mathematical proof that every single day you do not invest is literally destroying your financial future one day at a time. According to a study by Fidelity Investments, the most successful investors share 3 common behaviors. They start investing as early as possible, regardless of how much they have available. They invest consistently every single month regardless of what the market is doing, and they never panic sell during market downturns. According to JP Morgan, the average investor earned just 2.9% annually over the last 20 years, while the S&P 500 returned approximately 9.5% annually over the same period. The reason for that enormous gap is behavioral, not mathematical. Ordinary investors panic sell during downturns and miss the recovery entirely. They wait for the perfect time to invest and miss years of compound growth in the process. Warren Buffett made approximately 99.7% of his entire net worth after the age of 52. His net worth at age 52 was approximately $376 million. His net worth today is over $130 billion. The difference is simply time and compound interest working together. Since 1928, the S&P 500 has delivered an average annual return of approximately 10%. Over any 20-year period in the entire history of the S&P 500, it has never once produced a negative return. Not through the Great Depression, not through World War II, not through the dot-com crash, not through the 2008 financial crisis, not through COVID, not through the Iran War of 2026. A $1,000 investment in the S&P 500 in 1980 would be worth approximately $105,000 today. Even if you invested at the absolute worst possible time at the peak of the dot-com bubble in 2000, that investment would still be worth approximately $7,400 today. A gain of 7.4 times your original investment, even from the worst possible entry point in modern market history. The average actively managed fund underperforms the S&P 500 approximately 85% of the time over a 10-year period, according to S&P Global data. Right now in 2026, the Iran war has created significant market volatility. The S&P 500, which was down more than 7% at the conflict lows, has since rebounded toward record highs. Gold has passed $4,300 an ounce, up from just $300 in 2002. That is a gain of over 1,300% in just 24 years. Silver has hit almost $70. Global inflation is projected to stay elevated between 3 and 5% annually through 2028, according to Goldman Sachs. Every single day that passes with money sitting in a savings account during elevated inflation is a day where that money loses more real value. The mathematical case for investing right now has never been stronger or more urgent. So what can any ordinary person do right now? Start investing today, not tomorrow, not next month, not when the market feels safer. Every single day of delay has a specific and calculable mathematical cost. Start with whatever amount you have available, even if it is just $50 or $100 per month. Invest consistently through dollar cost averaging every single month, regardless of market conditions. Focus on broad market index funds that track the S&P 500. Allocate 5 to 10% of your portfolio to gold as inflation protection. Never keep more than 3 to 6 months of living expenses in a savings account. Everything above that emergency fund should be working for you in investments and not quietly losing real value in a bank account every single day. If you are 30 years old today and you invest just $200 per month into the S&P 500, by the time you are 65, your portfolio will be worth approximately $790,000. If you wait just 5 more years and start at 35, that number drops to approximately $452,000. The cost of waiting just 5 years is approximately $338,000 from the exact same monthly investment of just $200. The mathematical proof is clear, and it is absolute. Every single day you do not invest is not a neutral decision. It is an active financial decision that carries a specific and calculable cost. A cost that compounds against you every single day you delay. The data from the last 100 years has already answered every question about whether investing works. It works every single time without a single exception. The only question that remains is how much longer you are going to keep paying the price of waiting.